All right, thanks everybody for joining the latest Iqubed webinar. We're talking about a study that we did a few weeks ago, which we've been sharing with people within the industry. Really insightful approach that we took with this analysis. A lot of great ideas, a lot of great findings that we wanted to share with you guys. And essentially what we set out to learn was how is inflation impacting our business? How is it impacting the supply chain? How is it impacting our ability to run a business and make a profit? How is it impacting our end users' lives, our employers that we serve on a day-to-day basis? So, many of us have heard Jason and I say what we love most about what we get to do is we can kind of stand on the outside and look inside our industry in a very non-competitive way and just provide insights and thought leadership and business advisory services to those in our space. We're not a threat to anybody. So a lot of doors open for us pretty easily where we can kind of ask these questions of peers within the industry and share in an aggregate form some of the findings that we have. So this was something that we undertook over the summer. We've been talking to a lot of people about it. We've been selling this research and it's just really interesting. And we wanted to get on a webinar today and share some of these thoughts with you. So my partner in crime, Jason Morris. Yeah, Jason, hop in.
Hey everybody, how you doing? Excited to see everybody this weekend at PBSA. I've got my Colorado hat on in anticipation. And like Kevin said earlier, we'll be hosting a meet and greet at 1 o'clock at the sports bar to say hello to everybody and come into the conference. Pretty excited about this project. We've been working on this for about 2 or 3 months. Kevin and I were sitting down and thinking about and hearing what's going on in the news with inflation and labor costs rising, and we just knew that it was going to hit this industry at a certain point. So we really wanted to go out there and ask people what they thought. Mostly so you guys can make better decisions. There's going to be price increase decisions you're going to have to make on your clients and stuff like that. So we felt it was a good way to arm you guys with appropriate information.
Yep, exactly. You want to do 30 seconds on who we are for some people that there's a number of people here. This is their first webinar for us.
Yeah, so for those who don't know us, I'm Jason Morris. I've been in the background screening industry for almost 27, 28 years. I'm alongside Kevin, who's been with me and worked and partner of mine. We are partners in Iqubed Advisory. We were at Employee Screen IQ together for many years, and really have our hand on the pulse, our fingers on the pulse of what's going on in the industry today. So some things that we focus on here at Iqubed is number one. Really, I'd say the number one thing that we do now is recruiting, and we find top executives for background screening companies. We focus only on the background screening industry. We're also doing a lot of M&A advisory, both from the buy side and sell side. So we've represented some people looking to sell their CRAs and putting them together as a matchmaker with either private equity or a strategic in the industry. Yeah. We do a lot of scale and growth consulting, go to market, and both of us do quite a bit of expert witness work as well.
Yeah, that last part certainly picking up. No shortage, unfortunately, of lawsuits in our space. So
that's a whole nother webinar. We should really do the top things that we're hearing from attorneys on some of these lawsuits being filed. I mean, I've doubled my caseload on expert witness work just in the last 60 days. So quite a bit going on the litigation side. Plaintiffs' counsel, as you all know, is very active, and I think those efforts have probably doubled or tripled since the pandemic, because those things kind of like they're on hold for a while, and these lawsuits are just being filed now.
Yeah, absolutely. And by the way, as always, throw questions, comments, jokes. You want to make fun of Jason, have at it in the comment field, even if it's not necessarily pertinent to our webinar, but we're all here now. If there's something you're interested in and we'll tackle on a future webinar, throw those thoughts in. Again, we love being in this industry. We love serving and helping. So nothing's really off the table for us. All right. So as we look at our agenda today, right, what we're going to start with is just kind of an overview of the screening space. I think it's really important we understand the size of the screening market. We'll share some insight into the different tiers CRAs in our space and those that we surveyed fall into. We have really solid insight into 4 of the 5 largest companies in our space, and as we approach this, and and I'll riff on this for a second. If we think of our industry as a $4 to $5 billion industry annually, and we can go round and round on those numbers, by the way. And I'm always happy to have that conversation, because a lot of the numbers thrown about in our space, I think there's a healthy set of smoke and mirrors in them in that analysis. But if we think of the size of the industry, our research really covers about 60% of that, which I think is a really impressive number, considering we're tracking about 400 to 500 truly legitimate CRAs out there. And even that number, that's mind-boggling, right? It's just a great reminder to all of us. The industry is not just who we'll see this weekend at the PBSA show. Jason, as you look at our agenda today, what are some of the things you're excited to talk about?
Well, for sure, the results of the study. Kevin and I massaged these results for quite a long time and looked at them and tried to pull out different data points on them. So I'm really just excited for everybody to kind of see the work that we've been doing on this. It's pretty simple. It's not a whole bunch of complicated data, but it's enough that I think that people can make effective decisions with. And also, some clarity on why these price raises are happening in some areas throughout the sector. So that, and then just to tell you what we have coming up next, which I think is some pretty cool stuff.
Yeah, so you're right. As we pivot to the next slide here, and we think of the major players that not only we have insight from, but the marketplace as a whole. There's something that on previous webinars that we have talked about. The middle is getting sucked out of our space, right? We look at the companies that have been purchased or merged over the last 12 to 18 months. There's 5 or 6 we can think of off the top of our heads that are no longer, and another 5 or 6 that Jason and I have insight in that may follow them relatively quickly. So we're kind of seeing in our space, like the barbell approach, right? You have a lot of dollars and a few number of companies here, and then you have just this long tail, and the middle is really being hollowed out. So one of the things when Jason and I prepared for this, it's not necessarily super pertinent to our findings, but we just thought it was really interesting for everyone here in the audience to kind of see these different segments and tiers in our space, as well as hear that insight of the market is really the middle of the market is quickly going away.
And one thing that's kind of cool that you guys will see in the future, for the last 5 or 6 years, we were hired by somebody in private equity years ago to just track the industry and look and see how big each CRA is and where their sweet spot is, what platform they're on, like just a full analysis of all 400 or 500 pure background screening companies. And we've kept that up to date, and we're going to be releasing that probably, I don't know, we keep saying next month, but it's gonna be a couple of months. And it really gives a lot of clarity from insiders as to what's happening within the industry. Every time you hear a report or see a report or look at the one report that was written by a bunch of investors, they say it's a $6 billion industry or $7 billion industry or $3 billion industry. Well, I mean, I could tell you pretty confidently most of those guys are wrong. Just through our research and the stuff that we put together, we've got a very clear understanding of the entire background screening space. So we're excited to release that. We're not sure what format we're going to release it in. It will not be something we just release for free. It'll be probably a fairly expensive report, but mostly geared towards investors in the space. But it's definitely something we'll be making available to everybody.
Yeah, you said it maybe more eloquently than I did. I just called this smoke and mirrors. So I think I said on a webinar like a year and a half ago, when we were talking about some of the publicly traded companies' estimation of what post-hire screening will be, specifically criminal monitoring. And I think it was estimated like post-hire screening alone to be 4 billion. And I said, if this industry ever does 4 billion in post-hire screening, I will run naked through the exhibit hall. So maybe that's a reason enough for people to not want to buy it. Okay, pardon me. Okay, so let's dive into some of the things that we found here, right? On the supply side, most CRAs expect price increases. Very few had gotten one at the time of our analysis. We're hearing some on the ground chatter that has changed for a number of them. But
that's aside from the work number, obviously.
Yes.
We know that there was increases.
Well said.
There.
Yeah. This is not work number specific. Everybody was like, hey, my data providers, and if we look at Another area of research that we do is on the supply chain. So we've identified about 50 different suppliers in our field. And it wasn't specific to just one or just two suppliers. They were like, hey, we know it's coming. We just expect it. Jason, what's kind of your take as we talked to these companies and looked at the publicly traded information? Was that a surprise to you?
No, I mean, we knew everybody's gonna have to react to the market. It's a matter of timing. Nobody wanted to be the first guy there with the increases. But since we released since we finished the report, and since we did the surveys, 2 months ago almost, we've heard of more increases, but it's still not everybody. But it's going to catch up. It's got to catch up. You can't just hide behind wage increases this significantly and not at some point have to raise prices on your clients. And I'm talking from the supplier standpoint. So,
yeah,
whether somebody's telling you they're not doing it or they're going to do it later, you gotta plan on it happening, because to do it right, and do background screening right and do the court research right, you got to pay for it. And we know that even the guys driving to the courts, their gas is more expensive. So we are going to start seeing those things across the board. It's just a matter of timing.
Do you think for the last 3 to 6 months, everybody is just trying to grit their way through it without having to? Yeah,
I do. I mean, nobody ever wants to have to raise prices on their clients. And especially less sophisticated CRAs. I think and we'll talk about this later on, the bigger CRAs, it's built into their contracts anyways, and they don't really have much of a problem doing it. But it's it's like we had, Kevin, 10 years ago when we talked about doing, raising prices on a few of our products and even charging for things that we hadn't charged for in the past. It was the right thing to do. And whereas it upset some people, the revenue grew because of it. And that's the goal of a company. So that's my thought on that.
Yeah, I'm excited in about 15, 20 minutes as we really get into the how. If you think back to a slide or two ago, guys, when you saw the agenda, this isn't just us regurgitating what your peers in the industry say. There's a lot of how behind this. If you want to do it, how do you do it? If others are doing it, how are they doing it? Where is it? Where do you win? And where are some common, traps that people fall into? So we tried to kind of outline some real life practical solutions in conjunction with some of the findings that we saw here. What was surprising to me, and maybe not once I stepped back and thought of it, is how many people at the onset said, yeah, I'm just going to take it. You're going to raise my prices. I expect you to. Maybe not a defeatist mentality, but the overwhelming feedback we got was, if a supplier raises prices on me, I'm going to take it and deal with it. So it seemed like the feedback we heard during our analysis was, it was really two-pronged. It was, okay, I'm going to take it, but it doesn't mean I'm going to like it or deal with it forever. There will come a point in time where I, as that business owner or as that vendor manager, they will look at alternative options. So I think for the provider network, there really is an opportunity to get business in the space. What do you think, Jay?
I totally do. I mean, the first thing that's going to happen on the supplier side is when prices are raised, people are going to shop. And we saw that. That was one of the people's first responses, but they also at the same time expected, at least a 5% raise. But that doesn't mean they're not going to go look elsewhere. That was my biggest takeaway from that part of it.
Yeah, and I know we'll talk more about the how later, but we just had a comment come in. Somebody said, hey, we're a small CRA. We raised price a couple months ago. And nobody blinked an eye. And I loved that feedback. I loved that comment, whoever submitted it. I am a huge price increase guy. Not because I'm trying to gouge people, but I absolutely think that there is a path to communicate a change in revenue. You don't have to live by 2007 pricing forever, in a way that allows you to run your business better and, quite frankly, put some more money in your pocket. Like, that is not a bad thing, especially as a business owner. It's okay to do. And one of the things that we find, and it's not specific to this analysis, but we talk about it a lot on other webinars. And I've done some podcasts on this through the Background Check Radio podcast. Like, other people are raising prices. Like, it's okay, guys, you can do it. So thank you for whomever submitted that. Jason, one of the things that we tested, and if you want to kind of share our findings with us, we tested if prices are raised on you, will you accept trade-offs to mitigate a price increase? Meaning options are teed up for you. Your search is going to take 30% longer, but I won't raise the price. Or the turnaround time is the same, but I got to raise the price. And we kind of teed that up to our survey participants. And by and large, they said no.
Yeah, the way I framed the question was like, would you take the same price, but instead of the researcher going to the court 5 days a week, they go 3 days a week to save money on gas or whatever that might be? And it was a resounding no. I mean, nobody's willing to trade anything off for any type of anything less than they already have today.
Yeah, and you noticed this wasn't a specific thing that you tested, but before we dive into the labor costs, you felt pretty passionate about that flawed logic and business owners kind of making some assumptions that might not work out in their favor. You want to share your thoughts on that real quickly?
Which flawed logic thing were you?
The COVID bump forecasting.
Oh, right. Yeah. So a lot of people were basing their pricing volume on the last year or 2 years, which we've all been calling the COVID bump. Everybody's volume was up, but that's artificial. It's totally artificial. We've seen that from every CRA we've talked to and every analysis we've done on every CRA, that bump is certainly artificial. So by trying to ensure that your volume is going to stay the same or rise is definitely flawed because the market says differently.
Yeah, and I thought that was a great takeaway when we kind of looked at the results. And maybe it factors in a bit that idea of, yeah, I'll take that 5 to 10% now because everything's good. Like the tide is high, boats are rising. Maybe it's not that big a deal, but businesses are cyclical. And one of the things that I think was pretty clear to us was, if this were an economic downturn and companies, providers came with that 5 to 10% increase, yeah, I think it'd be received a lot differently than in today's climate. Jason, you want to share your initial thoughts on what we saw with labor costs?
Yeah, I mean,
there's some pretty cool findings here.
None of this was a surprise. Wages are definitely going up. Every CRA that I talked to said that in order to keep current employees and bring on new talent, they were going to have to raise their pricing. I'm sorry, their wages. The floor used to be like $11 or $12 an hour, and that floor is much higher, especially on your line level employees. So we saw that across the board. We also saw the same thing with the suppliers in the industry. Their costs were going up. Their researcher costs are going up, especially those that employ researchers directly. And then as such, the costs for gas and everything else to get there rose as well. What we saw is also on the development side, the tech side, and this is we've seen outside the background screening industry, obviously, but it's costing a whole lot more to do any type of tech work, any type of coding or programming. Those guys are, I mean, I'm guessing, but I would say that their wages are 25 to 50% higher than they were even a year ago. I've seen that with other businesses I'm involved in too. So, that's the bread and butter of this business now. It's a lot of automation, a lot of court research automation, lots of verification automation, just your whole back end and front end. That all takes people that are now making a whole lot more money, and that's going to trickle down too.
Yeah, and 30 to 40% on the wage side for development is what we reported out, and that was pretty striking. And I don't think from the standpoint that the numbers surprised us, but that hit CRAs really quickly. So while a data provider or a court runner, like we said earlier, everyone was expecting the price increases, but nobody had really gotten them yet. The wage increase smacked everybody in the face really quickly. And where we saw it most strikingly was organizations whose development team members were overseas, specifically in India, specifically in the Ukraine. Now we know what's going on in the Ukraine. for a couple of years, or I'm sorry, for the last few months. So, I certainly think the military invasion by Russia has kind of been gasoline on the fire of wage inflation, because not only are we dealing with rising labor costs around the globe, now our supply of possible employees is more limited. They're protecting their homeland. They're not working on your development project.
Yep. And
a couple
domestically,
things going the wrong way at the same time.
Domestically, I think it's even worse. I mean, especially on the non-data side, and I'll just say on your line level employees. I mean, I talked to companies that believed that the $15 an hour floor was good and competitive. And to be brutally honest, it's not. If you tell somebody they can make $15 an hour sitting in front of their computer all day, or they can make $16 or $18 an hour driving for DoorDash or Uber and making their own schedule, making the same amount of money based on how and when they want to work, it's hard to compete with that. And the only way to really compete with that is, benefits and wages. So these things are going to keep happening. I mean, you can go, Starbucks is hard up for people. They're paying $20-something an hour to pour coffee. Not to minimize what those baristas do, but that's what they're doing. So how do you as a CRA compete with that? You can't unless you raise your wages.
Yeah, the lower wages that we heard through our analysis really surprised me. I heard a lot of people still in the $16 an hour range for their staff, and I think a real misnomer and irony in our space is, we're selling buttoned up accuracy, competency, quality, technology. I mean, look at a trade show booth at a SHRM show or an HR tech show next week, and the billboard, the face that our organization presents to the public. But a lot of our workforce is still low paid, and I might even call, depending on the position, low skilled. So I understand organizations that drive toward automation. They drive toward different fulfillment models. I get it. And I also have the business owner on the other side of my ear right now who's probably saying, yeah, there's just a ceiling on what I can pay people. And I think both things can be true at the same time. And as leaders, it's really our problem to solve, and how are we going to solve it? I'm getting a little ahead of myself, but are we solving it through investments in technology? Well, that's a big check you're writing right away. Am I selling it through just greater retention and higher skilled people by raising my wages? Well, that's a near-term solution, and it's probably less money in the near term, but that could be a steady drip, 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 because if that's your strategy, in 12 months, those dollars might be the same as the size of the check that you would have had to write if you're going to solve your problem through technology and automation. Which path is the right one? That answer is really specific to different companies. There's no right answer to that. But one of the things that we like doing when we have insight like this is sharing that these are things that our competitor or your competitors, but also your colleagues in the industry are facing. So in many cases, you're kind of not alone on this.
I would love to know what companies have put some data together and you are using data to make decisions like this. Like if you look 5 years ago and you're paying your verifiers, for education and employment, $12 an hour, and they completed X amount per hour, what that is today at $18 an hour, how many they're completing, if that numbers has changed at all. So if you're getting more for your dollar, maybe even less for your dollar, that's pretty interesting data to look at. And that's something that you guys should be doing to make, good data-driven decisions.
Yeah. I'll put you to test. I'll ask you this question really quick. We know our industry. We know the business owners and the leaders and the kinds of shops and the tiers. How many people are really using data to make decisions, and how many are, hey, we had a meeting on Tuesday and there were 4 of us and we decided this was a good idea.
Yep.
I mean, we know what people are doing, which I guess is good, because that's why our phone rings sometimes.
And that's something we do for companies.
Exactly.
We don't sit there and crunch the data necessarily. We can, but it's just showing them how to make better data-driven decisions.
Yep, exactly. Okay, so we supplemented our analysis with a real deep dive into some of the publicly traded companies in our space. And for those who don't know, Sterling, First Advantage, and Higher Right all went public last year, give or take a couple months in between each other. There's two other publicly traded companies in our space that we certainly look at. And the first is Meridian Link, that owns TazWorks. And the second is Equifax, which owns, if we go backwards in time, Appriss Insights and Innovative Enterprises and Secure Tech. So that's kind of the DNA of those two additional companies. A treasure trove of information. Some of it is just interesting. Some of it presents, real competitive advantages if you want to go and look at it, because they're required to, they're publicly traded companies. They can't mess around. They have to tell their investors what they're thinking and what their plans are. And they need to be honest about it, because there's financial penalties and jail time if they don't. So whether it's 10Ks, investor reports, earnings reports, PowerPoint presentations, we rip through all of this stuff. And so, Jason, if we want to toggle back here, we saw some really interesting things. And yesterday I was listening to, Sterling's latest earnings call. Jason, you want to tee up a couple of things that we saw from the larger companies in the space?
Well, we definitely saw that they are going to be raising pricing. That's the crux of what I got out of it. They look at the data very, very closely. They have to report their data and stuff like that to their investors in a pretty distinct way. So, the big companies will be raising pricing, and the big companies pretty much expect their vendors to raise pricing on them.
Yeah. I would say virtually across the board, they speak to the idea that their profits are determined in part based on their supplier costs. And I think that's a reasonable statement. Nobody could disagree with. What many of them say, and I would probably put Sterling at the top of the list in terms of their confidence in being able to do it. They're just going to do what they want to do. And I say that with a ton of respect. They're going to march in the direction that they've strategically set out there. And if you kind of look at, the last point there, they're building the future they want. They're not sitting around at the bar at a PBSA show talking to a couple colleagues and then saying, well, that sounds like a good idea. I think we're going to do that too. They're building into there. And again, this is insight. This is not judgment, not speaking ill of anybody. I admire anybody that gets to run their business the way that they want to run their business. So specifically, what are some of the things that they do and that they're disclosing? They have contractual obligations. In many cases, and I'm thinking Sterling specifically, they are building in the right to raise prices. They are saying you are our supplier of choice, or they're building in exclusivity. They have carve outs that if their costs rise, they can pass those costs along to consumers. And they win because they're not afraid to lose. So what do I mean like that? When you're $700-800 million as a company, and they're building in and disclosing, let's say, a 4 to 6% attrition rate. Okay, they expect to lose, if we do the math, $35 million worth of business. But they also expect to sell, and I don't have the numbers in front of me, but let's say they expect to sell $60 million in new logos. So it's all one big math equation. So if a larger company says to themselves, yeah, we're going to raise prices 4%. And some people are going to stay and some people are going to leave, but those who stay, we're getting 4% more. And those who leave, well, that stinks, but we're going to go get just about double in new logos through our marketing machine because we have a strong pipeline. Because we have a strong pipeline, we're not afraid of somebody leaving if we want to raise prices by 4%. They just have the ability to do that. And Jason, I'll let you weigh in here in a second. So much of it just starts with marketing, and lead generation and a strong sales team.
Yeah, it does. And really, the public companies have a keen eye to their own attrition. I mean, they, as a public company, they can't have more than a 1.5% to 2% attrition rate. They just can't. But they build in the new growth aside from that to make sure that revenue is continuing to grow every single year. The things that Kevin pulled out of Sterling are not unique to Sterling. It's the same with Higher Right and First Advantage as well. they have a duty to their shareholders to keep margins high and to make money. And at the same time, they have a duty to their customers to keep them happy as well. So it's a balance, but they can make more mistakes than we can, and try different things than we can. The one thing that Kevin said in the beginning is, they're building the future that they want, and that couldn't be more true. They're not coming. I mean, they're coming to PBSA. They're seeing what's going on out there. They're seeing what their competitors are doing, but they're not shaping their future based on what others are saying. They're shaping the future and looking for everybody else to follow. And we've seen that time and time again. So, that's a whole nother webinar on innovation and why it's important to innovate from even the smallest level. And look at a company like Checker that just, 5-6 years ago was saying they're going to do it this way, and it's different than we all do it. But Checker is now in the hundreds of millions of dollars in revenue. So,
Checker's valuation is the highest of any company in our space.
Any company in the space. So, you got to admire that in some circumstances. So, I'm going to switch to the next.
And a couple things before we pivot off of this, Jason. Really the theme, and I said there, hey, they're operating from a position of strength, but what there also are, and there's a real delineation here. These three companies, and then you throw TazWorks, owned by Meridian Link, and AppWorks, now owned by Equifax. These are professional businesses. This is just the product that they sell. And that's neither right nor wrong, but it is different than I think a lot of people on this call today, and a lot that we see at PBSA. So a takeaway that we have, and we'll talk more about, I mentioned at the beginning, the how, right? Talk a little bit about the how in the next 15 or 20 minutes, but it's good for us to recognize that from time to time, we need to take off the background check hat more often and put on the business hat. Because that's what large companies are doing. It's not to say you need to strive to be a $600 million business. You want to be a $600 million business, you got to do $600 million things. And that doesn't work with everybody's lifestyle or business goals, right? But if you're unhappy with where you're at as a business, whether it's low sales growth or smaller margins or fewer leads than you would like, it almost always goes back to the time spent in the business versus time spent on the business. I'll give a quick story. I work with a company, and they are wonderful people. But they are a small single-digit $1 million company. And that's what they're always going to be. Why? Because they love the business. Like they love the background check business. They love doing criminal record searches and employment verifications and reference interviews. They don't want to be out there creating an army of salespeople or creating a marketing machine so they can go from 5 to 10 to $50 million. They're doing what they want in their business. So it really is a judgment-free zone. If you're a $5 million business and you love everything about your business, that's great. Don't change a thing. But if you're a $5 million business and you want to get to 15 and you're struggling, it's been 10 years and you're not there. It almost always, in the work that Jason and I have done, not only as advisors, but having spent 20 plus years in the space, it almost always comes back to we're too focused on the day-to-day, week-to-week, month-to-month operations of our business, and not
strategy,
operating as business people.
Yeah,
so
totally.
I wanted to kind of make that point before we pivoted away. Okay.
All right, we pivoted.
Yeah. So a lot of things here, Jason, you and I have done really, really wrong early in our career. You want to run through a few of these?
Yeah, hang on a second. I've got my screen blocking. Yeah, so a lot of things that small business owners and people newer to business do that they don't realize the effect of is giving things away. And Kevin, I don't remember who taught us this. It might have been you that said it first, but when something's free, it just has no value.
Yeah.
So that's one of the chest X-ray things that CRA should be doing with themselves, and looking at all the things that they provide to their customers that could be chargeable services, and starting to think through that. It's important that you do it because there's things that you're doing that are costing you money, and you should be compensated for. The other thing is making sure that you're charging for different things appropriately. A good example that I can think of is we used to just mail things for free, mail adverse action letters and stuff like that. And then we started, charging for the stamps. But at the same time, there's more cost than just that. it's the person that has to put it together and print it, and the cost of the paper and the ink, and sometimes it's not 45 cents, it's 90 cents, making sure that those
Because
things
it's
are
a
being done.
15-page report,
Right.
right? And that's extra postage.
Right. So, those are the things that you really need to look at every area of your business, especially now as we head into this recession and come off this COVID bump. Those are the types of things that you should be looking at inside of your business to make sure that you're getting, I guess the best bang for your buck is the wrong term, but making sure that you're doing everything appropriately in that regard.
Yeah, it's and you're right, Jason, that idea of, hey, if you give it away for free, it has no value. That was a drum that I beat. But when did I start beating the drum? Because I did it the wrong way for 5 years. I just kept running into a brick wall. And the reason we tell this stories is for those of you that may struggle with the same things inside of your business, like, it's okay. It's okay to have a challenge, because there's a good chance that somebody else is struggling with the same thing. It's very unlikely that a challenge that you have inside of your business, you're the only person in the industry or the only company that's struggling with it. I know Jason does as well, but what I probably love, one of the most things about what we get to do right now is we get to see a lot of these things because we're not a threat to anybody. So we combine the work that we've done inside of a shop and now the work we do now to be able to really overlay and say, hey, you're, kind of one of three different ways. Your challenge is a challenge that's unique to you, and that's rare. Your challenge is commonly shared. Here's the way out. Or your challenge is the same as everybody else. There's no great marketplace solution. Everybody just deals with it. Like, let's move on. Trying too hard, fool's gold. I do not believe that clients reward you for making that 7th verification call when it extends into 5 days. So think things like that. Let's figure out a better way to persuade our client not to be mad at us because we did not get employer number 4 at Burger King from 5 years ago, when the employee worked there for 6 months. Like, we got to be good enough to have those conversations and not kind of scared of our own shadow. I think we're getting better at that as an industry, but there are still companies that I see that will just call and 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 wonder why clients are upset with them about turnaround time.
I think it's really it's really important to, and now I forgot what I was going to say. That's embarrassing.
That's all good. But we think of all of this and we're kind of just riffing on how to run a good business now, but we're tying it back to that core concept that we have to pay our employees more. Our data providers are charging us more, and we don't have a client base that is universally accepting of just the straight pass along. So in some instances, there's a path, where a client is going to be okay with that. In some, there isn't. And we have to make choices in our business. And is that choice a lower margin, or is that choice just a different approach inside of our business, coupled with a strong communications approach to win the conversation, which we'll talk about next slide. We don't have to go there right now. But the 80-20 rule. Yeah, go ahead. You remember?
Yeah, I remember. If you look at the way the software industry works, and some of the SaaS and the platforms and the marketplace and all that kind of stuff, and you look at how they charge their customers, some of them charge their customers even for tech support, or even for client support. If you're going to go above and beyond and not look in your own system to find the answer and you want to make a phone call, those are chargeable services. I'm not advocating that these are things that CRAs do, but some of those things shouldn't be a surprise to most of your customers because they're doing it with some of their other vendors. Sometimes I feel like, and I know that the background screening industry is not the software space, but sometimes I feel like we're something else, but we still believe we're a service industry. And we're dancing on the line of some other areas of business that's not the service industry, and that's where I think that we need to charge appropriately.
Yeah, I'm fond of saying, every business decision. I just kind of have 2 more points before we pivot, Jay. I'm fond of saying that, you come to water's edge on something and you really have 3 choices when we're communicating with clients. We can accommodate, we can negotiate, we can impose. Okay. Accommodate is, yes, we will do that. And maybe we charge for it, maybe we don't, but the answer is yes. A client asks for something and we do it. Negotiate is kind of that middle ground. And I think of this when we think of changes to products and do we charge and don't we charge? It's, the solution isn't just, or the pitch to a client isn't just, I used to do your letters for free, now I'm going to charge you. It's more like, hey, you lay out all the reasons like Jason just did on why we can't really continue to do it for free. Do you want to pay $4 for that? Or is it something you're just kind of comfortable doing yourself? Because at the end of the day, it's your obligation. And maybe a client says, oh yeah, I don't want to pay $4 for it. Yeah, okay. Or yes, I'll give you $4. But in either case, you're not the bad guy. Like you're giving them an option. They're the ones making the choice. And then that 80-20 rule, I think, especially for we think of the industry as a barbell and the long tail, a lot of really small companies, the 80-20 rule is the hardest in our space. 80% of your clients could be 20% of your profit and vice versa. I have one client in particular, and probably one of the least pleasing things about our space is sometimes you give advice and somebody chooses to do something else, and that's okay. But I have one client who a bulk of their business is low margin, low dollar amount, volunteer work, and staffing work, and that to me isn't the path to long-term sustainable success as a business. And they pivoted away, but recently they kind of jumped right back into that. Why? Because that's where their marketing generated a lot of their leads, and that's where it was just comfortable. Like change is hard. I get it. Change is hard. It was very comfortable for them. So the 80-20 rule, they kind of really struggled with that. And again, if you're happy with it as your business, that's great. But sometimes there's other opportunities to win. Okay, Jason, you want to take the lead on this?
Yeah, so I think that this is something that it's not something you're just going to wake up one morning and be like, we're raising prices 5%. It's something you got to put a lot of thought into. So, what's the first thing I would do? I would have some conversations with your A-list clients. Have your account managers, your strategic account managers, having those conversations, those tough conversations with your clients, kind of gauging their reaction. This is something that we're kicking around. It's going to come to you in a month or so. Just want to know what you think about that, all the way down to actually doing a survey monkey or some sort of survey to all of your clients, looking at what their tolerance might be. But probably the best way is start big. I would take a cross section of your clients, take a couple of your top clients, a couple of your middle clients, a couple of your smaller clients, and slowly raise prices on them, see what kind of reaction you're getting, and then wash, rinse, and repeat with your next batch. Doing it across the board could if your teams and you specifically are not willing to have those difficult conversations with those clients, I would absolutely do it in tranches. If you're somebody that maybe the public companies are going to stick by their guns no matter what and is contractually able to do it, I would do it. You could do it that way, but I like the tranched approach and making sure that you're able to answer the tough questions when they come to you.
Yeah, pilot programs are your friends, guys. And I think the wonderful, ironically, right? Because nobody wants to have that conversation. Nobody wants to hear that conversation on the other end. But I think we're living in a really unique space right now because all the chatter in the world is about rising wages and quits and inflation. So you have a built-in excuse. If we're going to get a letter or an email or a phone call and we're going to raise your prices 6%, are we going to be more comfortable with it in a 2% inflationary environment or a 7 or 8% inflationary environment? Because it's in our ecosphere right now, I think it's a much less risky way to do it. We're just kind of in this space here where for all of our fear, doubt, and uncertainty about how those conversations go, we're in an okay place to do it. Client risk model. What is this? This is something I'm really, really passionate about, and I've created a lot. And I'll explain what it is. And I'm not trying to sell it here, but just kind of what's this concept. I like to look at clients across 10 or 12 different touch points. And then I make a really simple, really analog, low-tech effort make a red, yellow, green estimation of how they feel. And it does, and your account, like Jay said, your account managers can kind of do this. Maybe your leadership team can do this, but it's hey, how do they feel about our quality? Did we just miss a record for them last week and had a big blow up with the VP of HR? Or did we just have an account review a month ago and they saw that we have a 99.9% accurate blah, blah, blah? Like, did they hug us on the way out of the account review? Or did they rake us over the coals because of our work? And you assign a red, yellow, green to that. Another element is, go ahead.
Something we used to do, which I think worked very well, and I know that a lot of the CRAs are doing this, but you have an executive sponsor for your top 10% of your clients, your top 20% of your clients. From your senior VPs to your CEO, even your CFO. They got a list of 5 people that they really can work well with, and things get kicked up to the executive sponsor. But those executive sponsors are looking at those reds, yellows, and greens to make sure that there's very few reds, very few yellows, and mostly greens. So I would, that's something that I would absolutely recommend is starting an executive program like that, and something that we did, and it was very, very successful.
Yes. Yeah. Right. And in addition, building off what Jason said, how's the strength of our day-to-day contact? Red, yellow, green, right? We have a client support associate talking to the HR associate, that might be green, but the executive level, the person who's going to like or not like a price increase, well, maybe it's red because we haven't talked to them in 6 months, or maybe it's red because the person who signed the paper isn't in that role anymore, and there's somebody new in, and we don't have a relationship with them. So it's not just about, we can't think about the strength of a client relationship as just kind of one thing. It's where within organizations do we have those relationships. Jason, I'm sure, remembers we had a enterprise level account, probably $750,000. We had this account for 10 years, and we had little to no executive level relationship, and it terrified us for years, and they just weren't interested in it.
They didn't care. They're like, we'll write you checks for $100,000 a month, and we don't ever want to talk to you.
Yep. The day-to-day contacts were great, green across the board. No executive level relationships. Jason, myself, nothing. Scared us like crap for 10 years. We kept cashing the checks though. And it really, it helps you figure out and just assess who's about to walk, who's going to stay forever, who's in charge. I mentioned the VP of HR. One thing companies get wrong a lot is identifying who's in charge. I have a client that lost $1 million account a few months ago, which was part of the genesis of us beginning to work together, because they thought they were in great with the decision maker, and they found out the actual decision maker was 2 levels up. They had never met that person, and one day they got an email. That's the worst kind of email to get. So, a healthy level of fear, uncertainty, and doubt about those client relationships is really, really important. Doing good work is not good enough. The relationships also have to be strong. And then our last point before we pivot, Jason has a board meeting at 2, so we're going to end a couple minutes early so he can visit the little boys' room. But practice, and power. Okay, if you're a $5 million shop and you're having the call with your largest company, your $500,000 employer client, you're probably having that phone call yourself. Okay. But you're not going to do all these yourself. You're going to have your team help you. Okay. Practice, and empower. So what do I mean by empower? Give them enough rope. Make sure they know that you trust and are confident in their ability to have the conversation. Not every conversation is going to be lollipops and roses. Some of them are going to go a little sideways. But what we very much want, and again, are you communicating this via email? Are you communicating this via phone? Sometimes the phone's going to ring if you do it via email. Trust your team to have these conversations from a position of strength so they can do their best to kind of assuage any concerns or answer any questions. If your team is not confident and they think that you in the back room are going to overrule them, they are going to be timid, they're going to be weak, the client's going to pick up on it, and it's just going to create a lot of mess in your business. And I tell you, nothing's worse in a client relationship than saying you want to increase prices 5%, and then the client barks at you and you fold. Now you didn't get the money and your team member thinks you don't trust them. So that is not a recipe for success. So practice, but at the end of the day, show your team that you trust them.
Before we
Okay.
get to this, just wanted to kind of, some other high level things that we gleaned from the report. People are starting to think about outsourcing more. Companies, some of the companies we surveyed are already doing it, and others are thinking about it. Some companies are considering buying more product from the same vendor so they can get better price, have less price increases and just get more bang for their buck out of more volume to one vendor. We're seeing fulfillment models change for sure. And I think the last thing that I got out of it is technology costs are going up across the board equally. So it's not something you're just going to see from one supplier, not the other. It's a true cost. Lastly, somebody asked the question in the Q&A about considering inflation, what should their goal be of profit margins? That's really hard to answer for somebody. But what I can tell you is if you take, obviously you're look at your P&L and your balance sheet, and you want to make sure that you're obviously making enough money to service your customers and make a profit and do all the things as a business that you need to do, and make sure that you're saving for a rainy day. I can't really tell you what your profit margin should be. I know that margins for services typically range around 40 to 50%. But blended in with everything else, that's really a question that only you can answer for yourself. Kevin, you're on mute.
Yeah, I saw a question come in, and I'm glad you took a stab at it, because I kind of feel the same way. Some shops, just the product mix is radically different. Some shops are extremely heavy, and I'm thinking of two specifically as I give this answer. One shop is extremely verifications heavy. Their margins are going to be lower. Verifications are just hard, whether you're doing it internally, whether you're using third parties, whether some of the additional software providers out there are helping you. It's tough to make a ton of money on references and employment verifications. One shop I know is extremely criminal heavy, probably 90% of their revenue. They're a large company, right? But they just don't do much with verifications. It's not their cup of tea. Their margin is going to be a lot different. Criminal is a higher margin product. So the blend Jason mentioned is important. And that came in as an anonymous question, but whomever submitted it, ping us and we'll give you an honest answer based on what we know about your business.
So two things. Oh, go ahead.
No.
I mean, two things that we're working on diligently that, if you guys are interested in learning more about or possibly purchasing, let us know, because it'll light a fire under our ass as they actually get it done. But they're
done. We just customize it for everybody.
Right. They're done. The data's done. The analysis is mostly done, but we got to make it look pretty. We've analyzed over 400 CRAs. We've talked, we looked at their PPP loans. We looked at how many employees they have, what platform they're on, their growth, anything that's kind of in their wheelhouse. A really good analysis. So that's something we've got. And the other is the same type of project, but we did it on the supply chain and hit about 50 to 60 of the top suppliers to the background screening industry. Really, really, really interesting information has come out of those, especially the first one. I use that first one. I use the data in that first one, I would say almost on a daily basis. Every day. Almost on a daily basis when I'm talking to clients or prospective clients, or even doing expert witness work, just talking about the size of the industry. So that's something I'm really excited about bringing home for our customers.
Yeah, and we wanted to share that for a second, Jason. If you want to go back to that for a second, part of it, I wanted to include. It's not a focus, obviously, what we want to talk about today. We wanted to talk about wages, inflation, how to make it work inside of your business, have those client conversations, right? Part of it, not so much a sales tool, but, listen, what Jason talks about, there's a $25,000 report and a $2,500 report. So when we talk about customizations, that's what it is. I don't think anybody on here needs 25,000. Somebody that's about to make a $5 million investment, in a CRA, well, maybe they need a $25,000 report. But the reason we talk about this, and I wanted to share it again, less as a hey, come buy this from us, but we wanted to peel back the curtain a little bit on what informs our thinking. Jason and I do not wake up in the morning and get on a call together and say, hey, I had one phone call and that's what this person said. And then we get on a webinar or stand up at a PBSA show and talk to a couple hundred people and say, this is how it is. We're always reading, studying, looking, analyzing. So, and this is fun stuff that we get to do. We really enjoy it, but it also gives us really good insight into kind of the state of the industry. PPP loans, that was fascinating for us. Gives great insight into size of companies and what their strategic objectives are. You know, you have a high revenue company with very low PPP loan. Well, that's because they don't have many employees. What's that say about their technology, their fulfillment models, the products that they're selling? You have conversely some lower margin CRAs with a ton of employees, right? Two different companies. And the supply chain stuff was really cool. I remember for the last company we did this for, Jason, we kind of built out, you know, a 2021, a 2023, and then a 2025 model. Like, what does the supply chain look at 3 different snapshots kind of in the future? So that's fun stuff. Like, if we see you next week and you want to learn more about it, just ask us. We love geeking out over this stuff. And speaking of next week, and we'll give Jason a couple minutes at the little boys' room. If you land early and you're looking for something to do, you want to watch some football, stop at the Mountain Pass Sports Lodge at the Gaylord. We'll be there from 1 to 3, just buying drinks for anybody who shows up. Jason, Nick, and I are presenting Monday morning, kicking off the show after the opening session on how to identify and connect with the right buyers in our space. We collectively, we believe a lot of money is left on the table because we try and sell all of our wares to one person. And then we go back to our sales manager and we wonder why that the head of talent acquisition doesn't care about post-hire criminal monitoring.
Yep.
They shouldn't. Their job's to hire talent. It's the compliance and the risk manager who cares about post-hire monitoring. So we're talking about how to kind of identify and open some of those doors. And then lastly, you know, Tim Santoni's on the call. Maybe he's a cornhole savant. He's going to knock me down, but I'm happy to play cornhole at one of the events on Monday.
Well, I'm excited.
I like geeking out over that stuff.
I'm excited because many of you I've known for over 25 years, and I consider some of you family. And my little baby girl, my daughter is a senior at Boulder, and she's gonna stop by the conference.
Oh, will she?
A couple of times, and everybody gets to meet Hallie. I'm pretty excited about that because, like I said, I've known a lot of you for a very long time. I'm really excited for her to meet everybody.
And she'll see people kind of come up and say hi to you and give you a hug, and she's gonna be like, "This is just my dad. Like, why is he so special?"
That's the most exciting thing for me for the conference.
That's really cool. That's really cool. So Jason, we'll get you out of here 2 minutes early. A couple of the questions we weren't able to get to, but we'll ping those people who had asked. Thanks again. We'll see everybody in a couple of days. Jason, any final thoughts?
No, I'm looking forward to seeing everybody again. Kevin, you and I can wrap up later, obviously, but super excited to see everybody again. Obviously, I couldn't be at the last one because I was held up in my hotel room with COVID, the last annual at least. This one's going to be a rager. Looking forward to it.
See you in a couple of days. Thanks, everybody.
Yeah.